This week, within a 24-hour time period, U.S. Treasury Secretary Janet Yellen's financial markets are operating fine line, changed to concern about the loss of adequate liquidity in the U.S. Treasury market at the moment. Many believe this is a forewarning that the Fiat Federal Reserve and U.S. Treasury are going to begin bailing out the largest bond market in the world with another seemingly infinite QE cycle to come. Interest rates on U.S. IOUs have been screaming higher of late, but they have also been large losing investments this year. The yields across the curve have yet to even hit the underreported core PCE price inflation rate. Meanwhile, across the Atlantic Ocean, rumors continue swirling about Credit Suisse, a global systematically important bank that we've covered here in the last few weeks. New York Fed data is now showing both the Swiss National Bank and the European Central Bank have tapped the Fiat Federal Reserve for short-term fiat US dollar loans in the size of $10 billion this week for the Swiss National Bank. The exact reasons for their needing to do so is not fully known, but it's been speculated, and a lot of people have been pointing towards Credit Suisse. The 15-year UK gilt bond has lost over half its value since 2020. In just over 2.5 years, a loss of more than half. The typical 60% stock, 40% bond portfolio performance meltdown in 2022 is now the worst on record, beyond losses seen during the 1930s Great Depression kickoff. In commenting on this terrible stock and bond market performance, Dylan LeClaire wrote, "The last time the U.S. market faced a drawdown of this magnitude, the U.S. government defaulted on its gold peg within the next 24 months. 1933, Executive Order 6102, 1971 Nixon shock." Not the best quadrant to find our 2022 financial markets in other words. And so now it appears that the runway is being laid for yet another cycle of bailouts and infinite QE as the global financial markets stumble into dysfunction yet again. Alleged criminal and CEO of JP Morgan Chase, the world's largest global systematically important bank, had the following take this week on where financial markets are going. Have a listen.
This again is fairly typical. You know, markets go down, the IPO market closes first, that's kind of happened. High yield closes second, and structured credit, that's kind of happened for the most part. You know, things can get done, and then it starts to affect other credit. You saw it with the gilt markets here, you see a lack of liquidity in a lot of markets, a lot of intermediaries can't intermediate like we used to because of regulations. It is going to happen. And I think the likely place you're going to see more of a crack and maybe a little bit more of a panic is in credit markets. And it might be ETFs, it might be a country, it might be something you don't suspect. If you make a list of all the prior crises, sitting here, we would not have predicted where they came from, though I think you can predict it this time that it probably will happen. And so if I was out there, I'd be very cautious. If you need money, go raise it.
What about stock markets? Where do you see the trough for the S&P 500?
Oh, I don't know. No, look, it may have a ways to go. I mean, it really depends on that soft landing, hard landing thing. And since I don't know the answer to that, it's hard for me to answer that. But it could be another easy 20%. And I think like the next 20% will be much more painful than the first. Rates going up another 100 basis points are a lot more painful than the first 100 because people aren't used to it. And and I think negative rates, when all is said and done, have been a complete failure.
Turning to this week's underreported U.S. government price inflation data update called the CPI, or Consumer Price Index. It came in hotter than expected with an 8.2% measurement. Even historically high price inflation nations like South Africa, Brazil, and India have lower official, but also likely suppressed price inflation figures at the moment. Many asset classes sold off on the high U.S. price inflation news. Twisted logic being that such a high U.S. inflation number sets the stage for the Fiat Federal Reserve to raise rates yet again and soon. Basically, anywhere one looks in the world, it's hard to find a fiat currency in issuance that's not losing double digits in real price inflation per year versus real goods and services. In short, maintaining one's quality of life appears to be getting harder nearly everywhere. And while headline price inflation adjustments for fixed income retirees look large, it's safe to bet that these paltry sums are not keeping up with price escalations, either at home or as well abroad.
Hello there, on behalf of SDBullion.com, this is James Anderson with a quick SD Bullion market update.
Before we go further, please smash the like button so other sound money stackers can also see this content. And be sure to subscribe to our SD Bullion channel so you can get our latest market coverages and also a chance at winning incredible Bullion giveaways like this one.
Get ready for SD Bullion's Monster Box sweepstakes that includes 500 Silver Eagles. You could be the next lucky recipient of a phone call like this.
This is Dr. Tyler Wall, CEO of SD Bullion. Well, I'm calling you to let you know that you won the SD Bullion giveaway of a Monster Box of Silver Eagles.
So click the link below for your chance to win.
Click the link below to enter our new 500-ounce American Silver Eagle coin Type 2 giveaway contest. And good luck to all of you who take part. The spot silver and gold prices sold off steadily throughout this CPI price inflation updated week. The spot silver price closes near $18.30 an ounce, while the spot gold price closes near $16.50 an ounce. The gold-silver ratio blew back and upwards toward 90 again. Given the fallback in gold and silver spot prices, our physical bullion buying clients have been buying these spot price dips again today and this whole week in very heavy volumes. The industry continues to see robust bullion buying sprees, especially when fiat US dollar spot prices dip like they did this week. And yes, this week was no exception. Large bullion buying volumes are taking place. And it's for real reasons. The news I'm bringing you here goes deep into the core of what is apparently an increasingly shakier global financial system, while simultaneously the circulating fiat currencies around the world are storing value about as terribly as they ever have, or at least collectively, since the 1970s. Add into this crazy cocktail that we've created the ridiculous amounts of capital now that are looking for safe havens in our tiny bullion market. It's got a potential ticket to unaffordium, unfindable good luck land. Of course, we'll be here next week to give you the SD Bullion market update, and we're about to hit 50,000 subscribers. So if you're watching this, and if you like regular bullion-related content, subscribe. That's all for this week. As always to you out there, take great care of yourselves and those you love. If you enjoyed this content, be sure to give our video a thumbs up. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content.